Development Service. The BATES program is a major step forward.
A game changer for the Black business community.
Designed specifically for Black entrepreneurs, by Black entrepreneurs.
BATES provides expert help to Black businesses.
It addresses the most important barriers to Black success.
Entrepreneurs need 4 things to be successful: access to capital, to network, mentors and sponsors, access to processes.
Une façon de travailler avec les entrepreneurs pour vraiment les amener à optimiser et maximiser leurs projets entrepreneurial.
We're going to sit with you and we're going to wrap you around the best experts we have.
CashPro will help Black business owners get access to more payroll resources.
Anybody that needs to get more funds to amplify their business, ACBNs, we do grant writing sessions.
The support, it's tremendous.
I have a lot to learn and I feel as though I'm in good hands.
I'm really looking forward to all that we're going to be able to accomplish together.
Please check out bbpa.org/BATES.
Land Acknowledgement. As we gather together, we acknowledge the sacred land on which we reside. It has been a site of human activity for 15,000 years. This land is the territory of the Huron-Wendat and Petun First Nations, the Seneca, and most recently, the Mississaugas of the Credit River. The territory was the subject of Dish with One Spoon Wampum Belt Covenant, an agreement between the Iroquois Confederacy and Confederacy of the Ojibwe and allied nations to peaceably share and care for the resources around the Great Lakes. Today, this gathering place is still the home of many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work in the community on this territory. We are also mindful of broken covenants and the need to strive to make right with all our relations. Last but certainly not least, we acknowledge the people of African descent who were brought here against their own will or in search of a safe place to live their lives and raise their children. Reconnaissance des terres. En nous rassemblant, nous reconnaissons la terre sacrée sur laquelle nous résidons. C'est un site d'activité humaine depuis 15 000 ans. Cette terre est le territoire des Premières Nations Huron-Wendat et Petun, les Scéniques et plus récemment les Mississaugas de la rivière Crédit. Le territoire était sujet de l'alliance de la ceinture Wampum plat avec cuillère, un accord entre la Confédération Iroquois et Confédération des Ojibwe et des nations alliées à partager et à prendre soin pacifiquement pour les ressources autour des Grands Lacs. Aujourd'hui, ce lieu de rassemblement est toujours le foyer de nombreux peuples autochtones de toute l'île de la Tortue et nous sommes reconnaissants d'avoir la possibilité de travailler dans la communauté sur ce territoire. Nous sommes également conscients des alliances brisées et de la nécessité de nous efforcer de guérir toutes nos relations. Dernier point, mais non le moindre, nous remercions les personnes d'ascendance africaine qui ont été amenées ici contre leur volonté ou à la recherche d'un endroit sûr où vivre leur vie et élever leurs enfants.
Hello, everyone, and welcome to BATES. Great to see you all. Continue to let the guests in just a moment. All right, so we have our special guests for today. We have David Rhodd and Ashton Ward. And just a reminder, before I go over their bios, just make sure that if you have any questions, we'll have a Q&A at the end. So you can either drop them into the chat or raise your virtual hand and we will call on you. So let me tell you more about our special guest that we have for today, Ashton Ward. Ashton Ward is a seasoned banker with 33 years experience in the financial industry as a banker, consultant, and mortgage and commodity broker. He has been a senior manager at TD Bank and he was a branch manager at Scotiabank. At Scotiabank, he had 8 years international experience as an expatriate officer working in Guyana. His experience and responsibilities included head of consumer credit, head of sales and marketing, establishment and development of 2 new branches, branch manager, and he spearheaded charitable committees. Also, we have David Rhodd. David Rhodd is one of the most renowned motivational speakers. He is a dynamic personality and highly sought after resource in business and professional circles for Fortune 500 CEOs, small business owners, nonprofit, and community leaders from all sectors of society looking to expand opportunity. For almost a decade, he has not only studied the science of money, achievement, and motivation, he's mastered it by interviewing hundreds of successful business leaders and collaborating with them in the boardroom, translating theory into bottom line results for his clients. He is also the author of House Rich, Cash Poor, No More: How to Use the Equity in Your Home to Achieve Financial Freedom. Now I will hand it over to David Rhodd and Ashton Ward. Thank you for joining us today.
Well, hello people. Just happy to be here with David. David and myself have collaborated extensively over the past, what we say, how many years, David?
It's been a long time.
At least 8 years. We are both serially unemployable, deciding several years ago to hang up our corporate badges for the world of self-employment. Personally, as a banker, I have seen and made many people extremely rich by giving them advice and working tirelessly to see their businesses grow. And while they were flourishing, I was just collecting my wages. I call it by being on the bi-weekly incentive plan. I got off that roller coaster and decided to become an independent mortgage broker, and I haven't looked back since. We know how to get people money. We know how to allocate money. We know how to create wealth. And I think today, David's presentation is going to help in giving you additional information that you need that will help to propel your fortunes forward. So over to you, David.
Perfect. Thank you, Ashton. And thank you for everyone for coming on the call today with us and spending an hour. It's so important to take this time to put into yourself. And I like the people that we're here with, because I know you're on the right track if you're dedicating this time to invest in yourself. So today I want to go through how to build generational wealth using real estate. I always like to start the presentation, figuring out, who do we have here, and tailor the presentation to be towards you guys. So this presentation, I'll apologize up front. This presentation can last, 2 hours. And obviously we're going to be going into some things that take a lot longer to discuss. We only have an hour here today. We're going to leave some time at the end for question and answer. And then even if we're not able to answer or address all of your questions, we'll leave the contact information for myself and Ashton that you guys can reach out to us, ask us any questions. Like, my goal for this presentation is I want that, once we leave our time today, that you have some actionable tips that you guys can implement today to start seeing some results and some changes in your lives. And then, like I said, if you want to further the conversation, we'll be available. So I'm going to share my screen. And I hope you guys can see my screen. Look for
yes.
Perfect. Hate going through the entire presentation and no one sees anything. So, all right. Okay. Okay, so learn income, tax man, expenses, and retirement. So the importance of this slide here is to just show that we all have something in common, and this is the journey that most of us usually go on. So we usually start with high school. Some of us leave from high school and just go into a job directly. Some of us leave high school and go into a business. Some of us go to, post-secondary education and then go into a career, right? Or eventually start a career and then go into business, like myself. And the whole point of this is to earn income, And this is the goal of most people. Now, as we are all aware, once you earn income, you get paid. But before you get paid, before that money enters into your bank account, there is one person that gets paid first, which is the tax man. And, that's fine. We use tax dollars to fix roads, to help subsidize schools and everything like that. So, that's the system that we're in. Now, the only way you can bypass the tax man, meaning the tax man determines upfront how much you're going to be left with at the end of every month, right? Because they take their portion first, and then they leave you with whichever is left. So the only way to circumvent that is if you're in business for yourself. And this is why we promote that everyone should be in business for themselves. And what I mean, and let me just clarify what I mean by that. You can have your 9-to-5 job, your career, but if you can just have a small business on the side, the things that you can do, you can write off expenses, and we're going to go into this a little bit more. You can write off expenses and you can have more tax deductions and stuff like that. That helps you bring down your income from your career, which then allows you to have more in your pocket at the end of the year, right? So there's so much different things you can do online nowadays to have like a supplemental business. So you don't have to leave your career. For some people that want to leave their career and just jump into business, that's another option, right? So usually at some point, once you're earning some money, you want to get a car. Then, some people have dreams to get a house. Once you have a house, even if you don't have a house, you have expenses. I'm talking about living expenses. I'm talking about heat. I'm talking about mortgage. I'm talking about all these different things, right? So there's what I call the hamster wheel in this system. And let me clarify what that means. So once you have expenses, and a lot of people have expenses just coming out of school, they have school debt. But once you have expenses, you have to work to pay those expenses. And once you're working to pay those expenses, you're getting your taxes deducted by the tax man before it hits your bank account. So the system that we're a part of, the government system, the banking system, the financial system, whatever you want to call it, they're making money hand over fist because you're paying taxes every single year. So that usually happens from, depending on when you start earning income, from 25 all the way up to 65. But then it doesn't stop there, right? So once you retire at 65, usually they say the life expectancy, it's getting longer now, but usually life expectancy is 20 years. So from 65 to 85, you're living your best life usually. And even at that point, the government forces you to start pulling out, if you have any retirement savings, start pull that out and get taxed on that again. And again, the tax is a revenue stream for the government. So they make money every single time you pay your taxes. Right? So I just want to show you what that looks like. So in the learning stage, it's like a little scoring system that I put together. In the learning stage, we're not taught anything about financial literacy, not in school. So no one's teaching us how to manage our money. We are encouraged to go into school debt. We are encouraged to get OSAP, things like that, to get an education, right? So those are 2 check marks, 2 points for the system, right? The financial system. In regards to income, we're making money. That's a point for us. That's amazing. We're making money. We can make as much money as we want. Now we can do things with our money, right? For now, this system, where it comes to taxes, we have to pay taxes. If you're in a business and you're writing off, you're bringing down expenses and lowering your taxes, well, then that's a point for you. If not, a point for them, because they're getting taxes from you bi-weekly, nonstop, 12 months out of a year, all 20 to 40 productive working years of your life. Plus, you need some place to store your money, which is the bank accounts. They're getting bank fees on top of bank fees for you storing your own money. House is, one of the biggest investments, which we're going to get into a little bit later, but that's a point for you, right? If you decide to own a house. But, a point for them is once you have a house, you're on a mortgage. And we're going to talk about compounding interest and how they make their money when you purchase a house and the land transfer tax that you have to pay once you get a house, right? That goes directly to them. If you get a car, most people finance cars or lease cars, taxes on that, payments on that, right? It's a continuous revenue system for the government, right? For the financial system, right? And when you retire, it doesn't end. It's the same thing, right? So we're going to dissect this a little bit more. We're going to go into it and see what does this look like on the inside. So there's usually 4 ways to produce income: employee, being in business, or owning a business, being self-employed. That could be like insurance agent, mortgage agent, or being an investor. But one thing that is common amongst all of us is that we have a certain amount of lifetime income. And this is, just want to pause here for a second, because your lifetime income is what determines, what you do with your lifetime income is what determines whether you become wealthy, rich, be able to pass something down to your future generation, or whether you cannot retire, or you just retire, or you end up broke, or any of those things. It's all about what you do with your lifetime income, right? Because a lot of us aspire to be, for example, millionaires. And if you look back at how much you get paid and how long you've been working, we actually did become a millionaire, but we don't have anything to show for it because of what we did with our lifetime income. So, we all get our lifetime income, and this is the way how I look at finances. All of our lifetime income goes into this bathtub here. And in the bathtub, there's 1, 2, 3, 4, 5 holes, 5 holes, 5 sewers on this bathtub. The biggest sewer is taxes, and we're going to talk about why that's the biggest sewer, right? The next one is your house. Your house can be an asset or it can be a liability. Depends how you use it. The other 3 are expenses. Do you eat out a lot? Do you have school to pay for, kids to take care of, car payments, light bill, everything. So, and if you notice, the water level has to maintain at a certain level for you to be able to invest and save, because we know, and if you don't know, I'm making it clear that if you want to build generational wealth, you need to be investing. You need to have the ability to save. What I find happens with most Canadians is that this bathtub, it's hard to keep the water level high, because if all of the water goes into the tax tube, the house tube, the expense tube, and then we cannot even maintain it to the level that we can pull out money for investments, that we can pull out money for savings. The stats show that over 75% of people are not ready for retirement when it happens. And it's because of this, because we're not controlling this area enough in our bathtub to be able to do all these things. But again, that's not your fault. That's not my fault. It's how the system was designed, the financial system. We weren't taught how to manage our finances in school when we were learning about everything else. The way how our mortgages are structured, the way how our bank accounts are structured, the way how car payments are structured, the way how the taxes are structured, it's to make other people rich and not you. So this is why it's important to understand the system that we're in. We're not in a secret society trying to beat the system or anything like that. But if you understand the system that you're in, you can figure out how to make it work for you. I'm not telling you to go against the system. I'm saying make it work for you. And with some small adjustments, we can help you do that. So you remember this image here? Let's talk about the problem with taxes. So the problem with taxes, we're in a high tax bracket, right? We get taxed on everything. We get taxed on pieces of gum. We get taxed on gas. We get taxed on our income. Everything is taxed. We have minimal tax deductions. The only way that you can legally reduce your tax requirement to the government is by having tax deductions. All right, so what is the solution? Increase your tax deductions, but how? We're going to get into that. You need business write-offs, right? If possible. That's why I encourage everyone to have that side business, right? And in the States, their mortgages are tax deductible. That's Canadians and US biggest investment, right? Or liability, a mortgage. But in Canada, it's not. So we're going to show you how to make your mortgage tax deductible. And everything that I say, I like to fact check it, because this stuff goes on the internet and everything like that. And you want to make sure that the person that you're talking to fact checked it. So the Fraser Institute came up with a report, And you can always find reports on this every single year, but this one is from 2020. And he said the average Canadian family spends nearly $39,000 per year on taxes. So let's zoom into what that says. So it says, last year, the average Canadian family, including single Canadians, earned $91,535. So what that means, in a couple situation, maybe each person's earning $45,000, right? Or a single person's earning $91,000. So, but from that $91,000, you were taxed $38,000, $38,963. So it's rounded up to $39,000. That's 42% tax on income, right? On your income going to taxes. So this is before you pay your mortgage. This is before you decide to go to the mall and buy yourself a nice outfit. This is before you eat, right? 42% is gone. So this is why taxes is such a big issue, because if we can keep more of that money, then we can put more of that money to work better for us. Because that's what we want. We want that money to work more better for us, so that we have money left over and we can pass that money on to our generation, right? So that's why taxes are so important. We have to focus on that, right? Because 42%, you're left with 58% to manage the rest of your life, okay? This is going to become very important shortly in our conversation. This is from the CRA website. Talks about interest deductibility and how it's eligible. And it's probably hard to see. But what it's basically saying here is that the CRA allows you to deduct interest on borrowings if you are borrowing that money for the purposes of making money. So if you're borrowing that money to invest, if you're borrowing that money, if you have an expectation that money is going to make money, you're able to write off the interest on the borrowings. So I'm going to show you why that's going to become important in a second here. We're going to bring it all together, so stay tuned. So now we're going to look at the second area, which is mortgages and expenses, right? So what's the problem that if you're able to get into a home, what do we see as an issue here? We have dead sleeping equity. This is where you have a house worth $1 million, you have a mortgage of $400,000, you have $600,000 worth of equity in your home, and it just sits there. It does nothing. We call that dead sleeping equity. Today, we want to show you how you can wake that equity up and do something with it. No, we don't have any mortgage tax deductions. Like in the States, they have mortgage tax deductions. We don't have any over here. Getting into a home is becoming harder, right? So, that's what it is, and we'll talk about that. Compound interest. Once you're in a home, you're paying interest on top of interest. So you're not paying simple interest. You're paying interest on top of interest. So as your balance grows, diminishes, you're paying interest on top of interest. And we're going to show you how that expands over time. High interest rates on credit cards. Credit cards are anywhere from 19 to 24%. And we're paying that, right? So when you're making your monthly minimum payments, we've seen some of these amortization tables that show us it takes 40, 50 years. If you continue to make that minimum payment, it's going to take 40 years to pay off this $5,000 balance because of the high interest rate, right? We have long amortization schedules. When you own a home, the standard amortization schedule is 25 years. So when you get into the house, we're expecting you to pay off the house in 25 years, sometimes even 30 years with extended amortizations. What's the solution? Get into a home. But David, you just told me about all these expenses and compound interest and high interest rate, long amortizations when it comes to owning a house. But you're still telling me to get into a home. It's quite confusing. I get it. I get it. And it's going to become clear in the next slide. Once you get into a home, if you have higher interest credit cards, if you have credit cards at 19, 20, 24%, anything over 8, 10%, put it into your mortgage. But don't stop there. If you're paying $500 a month on your credit card at 19 or 24%, put that into your mortgage, right? Then continue to take that $500 and apply that to your mortgage. If you can't pay the $500, pay $250, pay $400. But don't just put into your mortgage and forget about it. Also make the payment to your mortgage, because that helps you pay down your mortgage a lot faster. So that's one tip for you. Okay. So this is another article. This came out this year, but every single year these articles keep coming out, Canadian homeowners' net worth is exploding as renters get left behind. This is why I'm encouraging you, if you can, to get into a house. And preparation to get into a house, I know you need down payment, you need good credit, you need stable income. And that is just an entire, an all other day of a presentation that we can go into, and we can talk about it if you guys give us a call or whichever, right? How to prepare yourself for home ownership, what you need, what your credit score needs to be, how to save up for a down payment. Are there government programs that are available to help you to come with a down payment? And yes, there are down payment options and stuff like that. But what this article is showing is that Canadians, they've increased their net worth on average $73,000 each in the first 3 months of this year alone. Not talking about last year, the year before, just this year alone, $73,000 in the first 3 months. Whereas the renter, their net worth rose by $8,000. That's great, but much better for the homeowner. And only thing that changed is the renter, they're paying for shelter over their head. The homeowner is paying for shelter over their head, right? So the net worth of the homeowner went up $73,000. A lot of people don't even make $73,000 a year. We just talked about the average income being about $40,000 to $45,000. So imagine that. I mean, you go to work, 40 hours a week for 12 months to make $40,000 or $45,000, but your house already increased, or your net worth grew by $73,000, all by you covering the shelter over your head. So this is the reason why it's important to get into a home. So, I came up with this system, as the introduction said, just from talking to a lot of lawyers, a lot of wealthy people, sophisticated people, stuff like that. I wrote it all in my book, House Rich, Cash Poor No More. It's available on Amazon if you want it. Small little plug there. But so the way how this system works is, I'm encouraging everyone to get into home. I've mentioned that like 5 times. Sounds like a broken record, but it's really important. And the reason why it's important is because that's your greatest opportunity to build generational wealth. So again, step 2 is reduce your mortgage, debt, and taxes. So this is that whole bathtub image that I showed you prior, right? Because what I find is a lot of us get into a house and we are house rich and cash poor. Meaning, so we're great. I mean, we got into the house, which is an amazing step, but we're having difficulties managing the house. We're having difficulties staying afloat. We're having difficulties having any money left over at the end of every month. And sometimes, don't beat up on yourself. Sometimes just managing that situation can take 10 years, can take 15 years. So the sooner you're able to manage that situation, the sooner you're able to do some explosive things with your money. So as you see here, once we manage that situation, so once we get to a point where we build what we call as a cash flow plan, right? So it's not a budget. A budget means, you're restraining yourself to certain, to certain budgetary requirements. A cash flow plan means, you're doing everything that you can. You're out there trying to make as much money as you can, and you hopefully have money left over at the end of the month, even if it's $1, doesn't matter. And we're using that dollar to its best and highest use. So, wherever that dollar can go, whether that's to a credit card, to a mortgage, to an investment, we're using that to its best, highest use for you. That's going to give you the biggest return on investment. So usually what we do with our clients is, after they're into a property for maybe 2, 3, 5 years, and we have this under control, their property under control, and we have $1 of cash flow at least, then we show them how to pull out equity from their home and invest it. And right here, it's showing that we're investing it in multiple properties, but it doesn't have to be multiple properties. You can be investing this in business. We're going to go through some of the investments. You can be investing this in stocks if you have, a good appetite for stocks and you're knowledgeable in stocks. But the whole idea is pulling out that dead sleeping equity, right? Pulling it out of that liability initially, which is your home, and turning it into an asset, right? So leveraging that money now to invest in other things. The reason why I particularly like real estate is because the asset class that I'm in is real estate. My house was in real estate. So if I pull out money from my Brampton home or my Scarborough home or my Woodbridge home or my Pickering home, doesn't matter where you live. If I pull out money from that home, and let's say I pull out $100,000 and I put it into a different home in Scarborough, a different home in Newmarket, a different home in Hamilton, doesn't matter. I'm still in the same asset class, right? So basically what I'm doing is I'm actually diversifying my risk. So in the event, if the real estate market was to dump, which we've never seen that happen in the past 40 years and longer, but if there was some sort of effect that happened in the real estate market, right now, all of my equity is in one home, right? And each neighborhood is going to get affected differently. So if I'm able to pull out that money and invest some in Scarborough, Hamilton, Niagara, all these different areas, Innisfil, booming areas and stuff like that, I'm diversifying my risk. And when if the market was to crash, tank, explode, doesn't matter, it's not going to affect me the same. Okay, so I'm spreading out my risk instead of just leaving it into one asset. By doing this, by investing in other properties, because I'm going to show it based on this, we're able to pull out income from all those properties, pull out cash flow. And once we pull out the cash flow, we put that money into our bank account. So now we're able to generate more residual income, more cash flow income, more passive income. All these trigger words that you've heard people talk about over and over again. All right, so let's get into that a little bit more. So this is another tip number 2 it's another takeaway that I want you guys to take. So we talked about the system being structured in a way that suits the financial system, that makes the financial system most profitable. So normally as Canadians, we get paid, and let's just say, I'm with Scotiabank. Okay, so I get paid, my money goes into Scotiabank, my income, my paycheck. And then with Scotiabank, I have a savings account and I put some money over there after all my expenses. And then maybe Scotiabank has my mortgage or TD has my mortgage. Then I do a bill payment and I pay to TD or Scotia, whoever has my mortgage. That's normally, and you guys can attest to this, that this is how most of us handle our financial matters, our financial affairs. But what I want to show you is a different way on how to do it, because that way that we're doing it is not efficient. It works, that's what we've been taught to do, but it's not working for us in our best interest. What's happening is money's going into our checking account at Scotia. We're getting no interest there. We're not making any money on that money. We're paying bank fees on that money. The money goes into our savings account. I think it's Tangerine or ING, whether they're called now. They give us what, 0.1% on your money, which is, I appreciate that from them, but that's not going to get me anywhere. Okay, so we put money into our savings account. Then we transfer money, to pay down our mortgage, and it's just going to our mortgage. We're stuck on this 25-year cycle, and it's going mostly to interest, a portion of it to principal. But I want to show you to think a little bit differently. There's other mortgage products out there that work for you. So step 1, get a mortgage. We have $400,000 of mortgage. Step 2 is, let's just say you have income of $10,000 a month. Instead of putting this income into your checking account at Scotia, this mortgage allows you to put that into your mortgage. So what that does is that $10,000 goes into your $400,000 mortgage, meaning your mortgage balance is going to be $390,000. Okay, let's follow me here. $390,000. Now let's just say you have a savings of $15,000, right? So now you can put that also into your mortgage. And people always ask, okay, so I put my paycheck onto my mortgage. How do I pay all my expenses? So you get a credit card, and a credit card has a grace period of 30 days. So for 30 days, you can use that credit card unlimited, well, to the balance, and you'll have no interest, no 22%, no 19%, as long as you pay that credit card in full at the end of 30 days. So what I tell my clients to do is take that $10,000 income that you have, could be 1,000, could be 5. I'm just using 10 as a round number. You put that on your mortgage, it drops your mortgage to $390,000 from $400,000. With this mortgage, you are only going to be paying interest on $390,000, not the $400,000, because you just dumped in your paycheck in there for 10 grand. So we talked about the grace period of the credit card. So we use that credit card I was going to open up one of my credit cards, but so we use that credit card for 30 days. And before that 30 days is up, let's just say we spent 5 and we save 5. Okay, just to keep the number simple. We take $5,000 from that mortgage and pay off that credit card in full. So what just happened there? We paid no interest on the credit card. We used the credit card for 30 days. It's now balance 0. On the mortgage side, we only paid interest for 30 days on $390,000 versus $400,000. And then on day 31, because we left only $5,000 back in there, it goes back up to $395,000, and we pay interest on that $395,000. Just that simple step, and not every mortgage can do this. There are specific mortgages that allow us to do this. But just that simple step, I've seen people reduce their mortgage from 25 years to 15 years just by making that simple change. This is on top of making accelerated payments, weekly payments, putting your tax refunds at the end of every year into your principal and stuff like that. Because what we're doing here is we're paying directly down to principal. And sometimes this is overwhelming when you hear it the first time. So I won't go into it too much deeper, but we can talk about it after. So if you can imagine, instead of having your savings at Tangerine or any other bank that's going to give you 0.1% interest, wouldn't it be better to have that $15,000 sitting on your mortgage, reducing it by 10 or 15,000, and now you're paying less interest on that money. So effectively, your savings is earning you whatever the interest rate is on your mortgage. So if you're paying 3% on your mortgage or 2.64, whatever it is, you're making more money by putting your savings account on your mortgage than leaving your savings account to earn 0.1% at a different institution. Simple changes, simple changes. Plus, because you're paying less, that means the compound interest is not as much on that mortgage. Okay, so I hope you guys followed me that far. Let's take it up a step. So now we have a mortgage of $400,000, but we have the house is worth $1 million. So why don't we pull out $100,000 worth of equity? Right, the money's there. It's sleeping. It's dead money. Why don't we do something with it? So once we pull out $100,000 worth of equity, as soon as we're pulling it out to the expectation of making more money, making a return on this $100,000, that interest is tax deductible. That strategy is called the Smith maneuver, where I'm a certified Smith maneuver professional. What that is a conversion strategy of converting your mortgage to be tax deductible. So what does that really mean? So what it means is if I pull out $100,000, and let's just say the $100,000 costs me 10 grand per year, for example, to borrow, because I'm paying interest on this money through a line of credit. Well, that 10 grand is a deductible expense because I'm using that to invest in real estate, my business. I'm using that to invest in stocks. I can deduct that $10,000. And for each and every person, if you're in a career, that's going to bring down your tax obligation to the government. And if that brings down your tax obligation to the government, that means you pay too much taxes. So that at the end of every year, because you pay too much taxes, now you're getting checks from the government. Could be $1,000, could be $10,000. I just ran a case study with another client, high income earners, and over 25 years, just by using this strategy, by pulling up money to invest, they're going to get back about $100,000 over a 25-year period from the government, legally, safely, right? Just by having this tax deduction. This has been something that's been going on for years, many, many years. So that's one, okay? And I'm going to speed up this presentation a bit. So again, sorry, because I want to leave time for questioning. So again, we talked about pulling out that $100,000. So I went on TD last night, and I just wanted to update this presentation for you. And I just showed you what the monthly payment would be like if you pulled out $100,000 on from equity of your home. So it'd be $438,000. Sorry, $438 a month. And that's at an interest rate of 1.55. Let's just say the interest rate was 2.5. Let's say the interest rate was 3, because, on a line of credit, your interest rate is going to be higher. It's going to be up to maybe 500, maybe even, 550 or something like that. So that's what's going to cost you to pull out $100,000. Now, when you pull out $100,000, you have multiple things you can do with it. You can put that in the stock market. if you are savvy in stocks. Not my recommendation, but that's what you can do. You can put in real estate, which is what I would encourage you to do. You can put in private lending. We're going to speak about what that is. You can put it into gold and you can put it into mutual funds and stuff like that. A lot of people do that as well, if you're going to get a good return on investment. But like I said, because you're pulling out that money, you're able to write off the interest. Therefore, you get tax refunds at the end of every single year. What you do with those tax refunds, if you want to really maximize things, you can take those tax refunds, if it's $1,000, $5,000, $10,000, doesn't matter what it is, and now put that down in your mortgage. Now that's going to go directly to principal, and that's going to help you pay off your mortgage even faster. That's another tip. So I'm going to just talk about private lending real quick because that's what we like. So private lending on this scenario here, we needed $200,000, and I'm going to explain to you what private lending is for those that don't know. We needed $200,000. On that $200,000, you're going to get a return of 10%. So the investor's cash flow was $1,600 a month, $1,666, as you guys can see there. And the cost of funds was $867. That's $438 times 2, because $438 is for $100,000. We did 2. So $867 is the cost that it was costing us to those funds. Every single month, as you know, the investor got $1,667, and the total profit for that investor per month was $790 per month. Per year, $9,488 a year, right? And that's not including the tax deduction that we're also going to get. So, I mean, ask yourself this question, and you can answer this question yourself. Would an extra $9,500 a year, I'm rounding up, help you in any way? Is there anything beneficial that you can probably do with that $9,500, right? That you don't have to actually go out and put effort in to earn just by leveraging what you're already paying for, which is your home. Okay. So what is private lending? Let me give you some background. So private lending, that's one of the strategies that we use, is when you become the banker, we turn you into the bank. So on a regular basis, you know, I own Limitless Solutions Financial Group. It's a mortgage brokerage. On a regular basis, people come to me and they say, hey, I need to renovate my house. I need $40,000, $100,000. Hey, I'm in debt. Hey, I have CRA to pay back. Hey, my kid's going to school. I need money, blah, blah, right? And there's all these different reasons why people need money, and they don't want to break their existing first mortgage because usually there's a penalty on their first mortgage. So they take a second mortgage for a short period of time, usually 1 year to 2 years, meaning so as a company, we will give them $100,000, give them $50,000, and we're going to register it on their property, on their real estate. So what does that mean? If they decide to sell their home, even if they don't call me, I get my money back because as Scotia's on your mortgage, you'll see Limitless on your mortgage as well, or you'll see David or whatever. So I'll get my money back automatically, okay? If by chance they go into default or anything, if the house burns down, I get my money, right? So that's why we like private lending, because it's secure, it's registered on their property, and it's transparent. We don't have to worry about tenants. We don't have to worry about, you know, all this maintenance and stuff. We're just lending money, making a specific interest rate. And the beauty of it, we can do it from anywhere in the world. So if I'm in Florida, I can send money to the lawyer. The lawyer does everything for me, and I still stay in Florida on the beach with my toes in the water, and I'm making money on my money, right? So it's an attractive strategy for a lot of retirees. We also do real estate investing, which is, you know, we do rent to owns, you know, assignments, things like that. But we're just focusing on the private lending because we don't have a lot of time to go through everything. So why should I do all this? How does this benefit me, David? So we just use an example, a mortgage payment of $2,000 a month, original term of, you know, 15 years. Usually mortgage terms are 25 years, but I want to show this conservative example for someone that's already into their mortgage. Right. So you've already, when you got your mortgage from whichever lender, you've already agreed to pay this for 25 years. So that means they already know how much interest they're going to get off of you in 25 years. So in this example, at a 15-year, it was $74,000, right? Sometimes it's $200,000, sometimes it's $300,000, whichever. And I want you to understand something, that to pay off $74,000 in interest, remember, you need to make way more than $74,000 to pay off $74,000 of interest because of the tax that's being taken from you. And we talked about being 42 to 43% being taken from you, right? So you need to make a whole lot more money just to pay off $74,000 of interest. So with our plan, when you're implementing things like pulling out that leverage, pulling out that equity, investing it, making your mortgage tax deductible, taking those interest payments, putting it down on your mortgage, all these strategies that we kind of combine into one. Years saved, 8 years saved. That's great. That's awesome. Interest paid, $33,000. So the interest that you saved on this existing term that you're already committed to paying $74,000, you save $41,000 worth of interest. That's exciting. I like that. But what excites me the most is I want to just explain this to you, and then we're almost done to open it up for questions. So this red line here shows you how long you already committed to paying your existing mortgage. This blue line here shows you, with our help or with our strategies, how you can pay off your mortgage, in 8 years earlier. This green line, which is at 0, shows you something even more special. So you're paying $2,000 a month on your mortgage. So once you paid off 8 years earlier, if you were to take that same $2,000 and put that into an investment for the next amount of years that you're going to pay off your mortgage originally, as you can see here, you could see that by the time your mortgage would have been paid off, you would have created $248,000 worth of investment, of money, of wealth for yourself and for your family. So just by paying your mortgage off earlier, that gives you the opportunity to invest in yourself, to have your money grow more for you so that it lasts you through retirement, and hopefully there's some left over to give to your family, whatever, to build that generational wealth. So the total upside is $289,000. So that's what I wanted to show you. I know it was fast. I hope you got some tips out of it. I hope some stuff caught your attention, and I'm going to be opening it up for for questions. If you want to have a further discussion about this, I'm available. Ashton's available. Feel free to give us a call. We'll have a discussion, see what's a fit for you, do whatever recommendations we can. And I hope you enjoyed the presentation.
Thank you, David and Ashton. Excellent. So we already have questions. So I asked them, and they went ahead and already started typing them in. So we can go ahead and get rolling on that. So first question from Carol. In the US, they can buy low-cost homes at approximately $200,000. But in Toronto, the average house costs 1.7 mil. How can we double our investment in a home quickly when a down payment will be so high?
Great question. I love it. What I've been telling a lot of my clients is, you're right. The Toronto real estate market is overpriced, if I dare say that. It's expensive. A lot of people, what I say is, look, we have the ability to work from home now, especially with COVID and stuff like that. But even before that, what's wrong? I'm just going to spin a little. What's wrong with renting a house close to where you work? So let's say you work downtown Toronto. What's wrong with renting a house or a condo downtown Toronto and purchasing a home in Montreal, in Saskatchewan, and all these different places, and renting it out? I was looking at properties in Montreal, and the average detached house was $250,000. That was last year. I don't know what they are right now, but $250,000. Right? The whole point is you want to be a homeowner so that you can grow your wealth and take advantage of some of the strategies that I was talking about. But that doesn't mean you need to buy it in the hottest market, right? And of course, things are going to come up. Well, who's going to watch the property? Who's going to property manage the property? How am I going to watch tenants? There are resources and people that do all those sort of things. And yes, maybe you have to pay 5 or 10% to get that. And but the whole point is being able to buy in other markets. Some people even buy in the States while they're in Canada, because like you said, it's way cheaper, right? And our money goes further over there, and you can still implement some of these strategies. And then, after a while, if you want to buy something locally, and you can, then you do so. I hope that answers your question.
Yeah, I may add, David, I can say from experience, we have people buying homes in Nova Scotia, for example.
Yep. Turn on your
guy
camera.
just bought 7plex, 7 units. He paid like $500,000. He got 100% financing. And after everything, he was netting $1,000 a month.
Yep.
So you don't have to restrict yourself to the Toronto market. In the US, I have a contact that has properties in Florida. that are being sold. You can buy those pretty cheaply. If you put 25% down, you can buy properties that are cash flowing. Do not limit yourself to the high-priced market. If you want to build wealth, you have to go where there are opportunities and be flexible. Property managers are available in just about every location, and they can take care of all your issues probably better than you can. So do not limit your thinking and your opportunity to the GTA market.
And Ashton, if you can, turn on your camera too.
Oh, sorry.
There you are.
Okay.
Excellent. And that really goes into answering Craig's question. That was his question of to get into real estate market, does it make more sense to look outside of the GTA as house prices are astronomically high? So y'all did it.
There is this notion that, oh, prices are too high, we can't get in there. It's too high. We can't. I'm looking back to 2005 when I looked at the market in Canada. I was saying, oh, prices are too high. We can't do it. Oh, prices are too high. We can't invest. Oh, condo market is going to collapse. You can't invest. And where are we at now? So there's no time like now. Just go get it.
Michael, did you want to make a comment?
I actually wanted to ask a question. As I listened to the presentation, I know it's skewed towards using your home as an investment tool. But what about the guy that just want to buy a house for having a house? You want to use a house as just pure utility by having a house. Does all these theories and approaches you mentioned work for that person as well?
Yes. So to answer your question, I mean, just buying a house and living in it and paying off your mortgage as fast as possible. That is just, it's a no-brainer way to create wealth by just doing that one step. What we're trying to show you in this presentation is that if you want to take on a little bit more risk, you can actually, grow that wealth exponentially by pulling out equity and doing the same thing, buying more properties and renting it out, or putting that into private lending, or putting that into your business, right? Because a lot of us here are entrepreneurs. So taking out that money from your equity, putting that into your business, getting that marketing going, making your business thrive, then the extra income that's coming from your business, you put that onto your mortgage. And there's just, so yes, to answer your question, you can just pay down that mortgage. And
so irrespective of what your original objectives are, the tools and theories and approaches do work.
Yes.
Beautiful. Thank you.
No problem.
Thank you, Michael. Next question from Jonathan. Let's see, Jonathan, for David, or both. Can you advise as to which financial institutions offer mortgages which allow us to pull off this strategy?
Right. So there are a few institutions, and we'd have to look into the benefits of each one in particular to you, but a few of them just off the top. Manulife one is the one that we use a lot. Scotia can do it if you set it up correctly. National Bank. A few more lenders are coming on board with this same product. They don't all give us all the benefits, but that's a few of them off the top of my head. Obviously, once we talk to you and we look at your situation, well, I can say, okay, no, based on what you're going through, this is the one to go with. Or even start here for 3 years and then move to this one, something like that. But I hope that answered your question.
Next question from Nicole. Where do you go to find private lending?
To David.
Okay, I was gonna, if Ashton. Yeah, so private lending, you access that. I mean, we do that all day, all night, myself, Ashton, because we're in the mortgage business. Clients come to us all the time looking for extra funds. So realistically, what I'm saying is you need to partner up with a broker that understands private lending and has experience in private lending. That's how you access it. You're not going to be able to access it from your local like banking institution and stuff like that. Hence why you're getting a higher rate of return. It's not a public investment. It's almost an investment like, you need to know, someone needs to tell you about it to get into it.
I would add though that right now, from private mortgage perspective, I've had about $2 million in under management. David, I think, has a lot more, probably in the neighborhood of about $15 million under management.
Yes.
This is where his clients have allocated funds that they've taken out of, either from investments or equity out of their home, and has placed with him to put into private mortgages. So these people borrowing at, let's say, 1.99 or 2%, placing it with him, getting 8 or 10%, massive difference.
Yes.
And if they took the money out of their home via mortgage, they get the tax deductibility as well.
Exactly. And then also, I mean, like some people, like a lot of my clients have money in RSPs, LIRAs, RESPs, TFSAs. We're able to use those funds to also invest in mortgages without any tax penalties, consequences. Like you're not collapsing your RSPs, you're literally moving your RSPs from one institution to the next. And then that institution allows you to lend it out as a real estate investment because, it does qualify.
Next question from Annie. What strategy for self-employed entrepreneurs do you have for them to get a mortgage?
All right. So you want to, okay. So the strategy for self-employed, it's a double-edged sword when it comes to self-employed people. I'm self-employed myself. So the reason is because with self-employed, we tend to make income, but have a lot of expenses. So we declare little income to pay less taxes. So when a self-employed individual comes to me, I say, pick your poison in a nice way. Either you claim the right amount of income that's going to show up on your T4s and not claim as much expenses so that we can bring you to a traditional bank and get you fully financed, or you do it the way you're doing it, pay little taxes, but we'll bring you to a B lender, which is what we call a B lender. They're trust companies. They'll give you the mortgages based on what you're declaring, what your bank account shows and stuff like that, not what your notice of assessment shows. They don't even want to see that. And it's going to be a little bit higher interest rate. So if today interest rates are, let's just say around 2%, 2.24, these trust companies will charge you usually a percentage more, 3.5, something like that, 4.99 sometimes, and they'll give you the mortgage. So when I speak to a lot of self-employed people, they prefer to keep the business operating the way it's operating by not showing as much income and paying the mortgage with the trust companies just because it works out better.
I think the only caveat to that is that if you're going to a B lender, you need 20% down. So
that's correct.
You need to have that higher deposit amount.
Yes.
Next question from Carol. How do you deal with the U.S. exchange when you have to bring money back into Canada? Does that not severely take down your gains?
I don't see that, because if you have a property in the U.S. and you're getting rental income in U.S. dollars, if you're converting it into Canadian dollars, it's if $1,000 US in Canada is what, 13.5, right? So I don't see losses there.
And then just to add to that, a lot of investors, if they don't want to pay like any sort of double taxation, I'm not an accountant, so you'd have to speak to one. What they do is they'll leave the money in the United States. They'll get a United States credit card, use the credit card over here, right? You can buy your gas, all sort of stuff like that. And from the US account, pay that US credit card and stuff like that. So really, if you're worried about the conversion, the only money you need to bring over here is what you need, like cash, liquid cash. Anything else that's an expense, you just put on a credit card and pay for it in US dollars over there.
Next question from Bertha. What are the pros and cons of the reverse mortgage versus refinancing, or is equity line of credit a better option?
Man, I love those reverse mortgages. It's something that has had a bad stigma, especially in the States and stuff like that. But I just think, and there's a few of the companies that do it a little bit differently, so it's not really a reverse, but just being able to, and we need to talk about this in further detail to look at your situation, but just being able to get money up to 50% the value of your home. So if your house is worth $1 million, being able to be given $500,000 and not have to make payments on that money, man, there's just so much things you can do with that. I really like the program, and you know, it's something that I think people should look into, definitely.
Yeah, I would add for the reverse mortgage, you know, we're dealing with people who are over 55 here, right?
Mm-hmm.
I have a lady right now, she's about 80. She's got a limited income. She's struggling day to day to do what she would like to do based on the income that's coming in. She's got one son, and he pays no attention to her. And that's going to be her heir. So the question is, does she live the life she would like to live and having the access to resources? Or does she just stay living the life she has and leave everything to her good-for-nothing son? With a reverse mortgage, she can have access to the funds that she needs. She can use whatever she wants. She doesn't have to worry about paying a monthly interest payment. And whatever is left, you know, at the end of the day, the company would give the balance to her son, but she gets to live the life she wants to live with her money. After all, it's hers,
Yeah.
right?
And it's really also good. I mean, I've used it personally for my parents. That's how you know I really trust it. My parents just love it. So my situation personally was my parents were in a home, a very small mortgage, but they wanted to move to a bungalow. And if anyone knows, bungalows are in high demand. They're very expensive. So what we were able to do is we were able to sell their house, buy a bungalow, more expensive bungalow, and put the reverse mortgage on there. And they have no payments. So they are loving it. Just they did this last year, and you know, the interest rate at that time on a reverse mortgage, I think, was like 5 point something. Okay, their house went up $200,000 in 1 year just by making that move, right? So I mean, they're smiling. I am the number one son now. I'm ahead of my sisters and brothers. So yay, reverse mortgages.
Just to touch on the equity line of credit. The equity line of credit essentially is for people who want to have a readvanceable mortgage. In essence, let's say you have it at 200,000, you utilize it, you bring it down to 100,000 because you've had the ability to use those to get some funds in to pay down. You can readvance it up to that level. So it gives you the flexibility. It's a little more expensive because it's more or less it's readvanceable. I know of someone who had some cash. He had a HELOC, as we call it. He paid it down, and when he wanted to get some money to do a business, he just took it out. So that's the flexibility you get with a HELOC.
Thank you. And we're a little over time. Michael, I will add you back in to kind of give your final comment or words, and then we will go from there.
I think Justin wanted to say something. Can you allow him, and then I'll come on after?
Let me add. Let's see.
Dr. Perry.
Let's see. If
yes. Good afternoon, everyone. Sorry, it's a very interesting topic. I just want to say, I'll be very brief. I want to say it is very, very important, especially for Afro Canadians, to have a mortgage. Okay, I don't know how you do it, but it's a priority. Two things that Black Canadians should have. Okay, for example, it's only 7.5% of Canadians have mortgages. Black Canadians have mortgages. 7.5%. We're one of the lowest in terms of in the population. The average Canadian, 68.3% have mortgage, but only 7.5% of Black Canadians have mortgages. So it's almost critical. I'm not saying that, you know, but it is very, very, very important. Secondly, based on our research, it's also important for for Canadians, Black Canadians, Afro Canadians, to also be engaged in businesses. We have, in terms of the population, we are the least among us who have businesses. There are like maybe 25,000 businesses, Black Canadians, which is 1.5% of the total population. So our goal, hopefully, with the BBP and everyone, is to move that from 20,000 businesses to about 50,000. Okay, so if we have that, I think that we will do well and better as a community. But I just want to say that that's good information, and that's all I want to say. Thank you.
Thank
And
you, Dr. C.
I see some comments there. I mean, I'm okay to stay an extra 10, 15 minutes, but it's up to the organizers.
We haven't got the luxury, David. So,
okay, all right, good, no problem.
Yeah,
I
so
just see the comments.
We can take them offline. And but first of all, I'd just like to thank yourself and Ashton for coming on board and making the information available. I'm speaking on behalf of the BBP as its treasurer. As I listened to the presentation, I know a lot of sensitive information was provided, and we always like to see on programs like this that we make the disclaimer, that you should rely on your trusted advisor. Take what you hear here as just general, but you have to rely on your trusted advisor. So those folks who want to do some of the stuff that you have mentioned should reach out to you on a professional business level and not presume or assume that what you hear here is perfect and absolute. I know, for example, we talk about the reverse mortgage, and in essence, you're selling your home. That's what you're really doing. But it's not presented like that all the time. So I just want folks to understand that, yeah, some folks benefit a lot from it. Some of the bad feedback out of the States is that people aren't advised perfectly at what they're doing. And if the market goes south and house go below water, then folks have real problems. So, so while I'm saying thanks to you folks, I listen to a lot of the sensitive stuff. I listen to the call in a bank names and so on and so forth. And, we have to be mindful of those stuff because people do rely on it. But all in all, and on behalf of the association, thank you very much. I've actually taken down your number, David, so I will call you after this on a specific question I have, because I don't like what I hear. And as the doctor mentioned earlier, we in the space really don't have a lot of ownership of anything. So one of the purpose of what we're doing here is to educate so that folks can actually use the education to improve that percentage from 7.5 to wherever we should be, and from 20,000 business to 50. So thanks on behalf of the association. And I'm certain we'll be calling on you again later in this program or in another set of programs that we run to deal with this whole thing of real estate and how we can do things to improve our repayment and have intergenerational wealth transfer. So thank you. Excellent presentation.
Thanks for having us.
Thank you,
Thank you.
Michael.
Thanks for having us.
As you can see, they are requests and they're sad that we have to go. But we'll be back next week and we'll make sure that Mac with programs is here, so we know that this is a big one. So maybe we can have you back again. So we just appreciate your time and sharing all your knowledge with us. And so thank you, David and Ashton. All right. And thank you everyone for joining us today, and we will see you next time. Have a wonderful day, everyone. Bye-bye.
Yeah. Bye-bye. Bye-bye.